Hello and welcome. In this month's on-demand webinar, OJM Group partner Jason Odell provides an overview of cash balance plans and discusses how this modern qualified retirement plan can be a powerful way to save for retirement while reducing taxable income. Learn how physicians can use a cash balance plan to lower income to take advantage of Section 199A Qualified Business Income Deduction. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. We'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Hello, my name is Jason Odell. I'm one of the partners at OJM Group. I appreciate you viewing. Our topic today is going to be qualified retirement plans, cash balance plans specifically, and the advantage of utilizing one of these modern day types of retirement plans. We're going to speak on what are cash balance plans, why are cash balance plans used. We'll look at a couple case studies and then specifically look at an example of how utilizing a cash balance plan may allow you to take advantage of the 199A qualified business income tax deduction, which is a big advantage, especially for those that are in tainted services like medical practices. What is a cash balance plan? It is a tax qualified defined benefit plan. It is a qualified retirement plan. There are two types: defined contribution plans and defined benefit. This is a defined benefit plan. Most everybody is familiar with defined contribution plans. Those are 401k plans, fall under defined contribution. In a defined benefit plan, it's an annual allocation that's determined in the plan document as a percentage of either compensation or a specific dollar amount. It can have different allocation formulas for different employees or groups of employees based on job classification. There's an interest credit rate defined in the plan documents. They follow some of the same exact rules that are in defined contribution plans, like eligibility, subject to coverage, and non-discrimination testing, timing of your contributions, and just like defined contribution plans, if you're in a cash balance plan, which is a part of a defined benefit plan, you can roll over when you retire the funds into an IRA account. It does require an actuary certification, and it is subject to minimum funding requirements that need to be done. Why cash balance plans? Well, they're not typically universally known, although we are still seeing cash balance plan implementation or adoption grow at about 17% annually. It's a great way to save for retirement and reduce current income taxes. The amount that you can contribute into a cash balance plan is higher than what you can put into a 401k plan alone. But one of the major advantages is that it works well with a 401k plan. So you can have not only a 401k plan in place, but also then add a defined benefit plan and adopt a cash balance plan in place. You've got great current income tax reduction and deferral of taxes until distribution time. They're creditor protected under ERISA laws. And you can also make contributions into a 401h portion of a plan, which allows for tax-free retiree medical expenses. So you've got some big advantages here and why cash balance plans are important. Who's a good candidate? Not everyone is a good candidate for cash balance plans, but typically we see medical or dental groups are good candidates for cash balance plans. Those that want to save dollars for retirement in a tax-free manner are great candidates. Professional firms are good, like CPAs and attorneys, anyone that's a sole proprietor. Small, closely held businesses with not a ton of employees, typically it makes sense. We put moonlighting income. Moonlighting income meaning if you get any income from any medical device companies or royalties or things of that nature that are outside of your current medical practice that you want to use, you could potentially use a defined benefit plan and put in place a cash balance plan inside of that. Large companies with specific goals and a specific census makeup will make sense. And business owners, as I said, they want to save money for retirement and they want to do it in a very short period of time. A cash balance plan makes a lot of sense. Here's a sample of a cash balance plan. So for cash balance plans, they're actuarially certified. So an actuary is taking a specified dollar amount. In this example, it's $280,000, which is the limit dollar amount that can be used for the actuary to determine how much money can go into the cash balance plan. In this case, this 45-year-old had a current 401k plan and a profit sharing plan where they were putting $19,000 and $17,000. They also, their plan allowed for them to do after-tax contributions, so they were putting $20,000 away into the after-tax and then converting it to a Roth inside their plan. And the cash balance contribution portion was $164,000, giving them a total of $220,000 that they were able to put away. So there was a $92,000 savings in federal and state income taxes. Potentially that amount could have made them eligible for the 199A deduction. We'll look at that in a minute. And we're taking the $20,000 that they were putting into the 401k plan and converting. You could actually potentially take that $20,000 and put it into a 401h health savings account for future use. So you've got some big advantages on how one of these works. Let's take a look at a two-person group here and how it might work. You've got an owner of a business at 45 and her spouse at 40. She's making $280,000 for the limit for the actuarial calculation. He's making $98,000. And what you'll notice here is you can get a total of $221,000 between the 401k plan, the defined contribution plan, and the cash balance plan in on her behalf, and $167,000 away on behalf of him. So you've got $389,000 going away into a plan. And you can do this because the calculation allows for it. But more importantly, this, to be specific, their total income used was $378, and you can see $389 was put away. That's also because this 280 was the max number that could be used for the actuarial formula. She was making far more than $280,000 above, significantly more, which allowed for the $389,000 to go away. Now, if you look at a medical practice and you've got two physicians that are in the medical practice currently, one 55 and one 45, and they've got 3 employees. What you'll notice here is that we're able to, by using the actuarial formula, put $503,000 in both the defined contribution plan and the cash balance plan for both of the two physicians combined. And you've got $13,805 going away for the 3 employees. So there's a total of $517,000 being put away into the combination of the defined contribution and the cash balance plan. That's 97.3% going to the owners in this example, the 2 physicians in the practice. So you can see a significant amount of money can be saved, and a significant portion of that can go to the benefit of the 2 physicians. How might a 199A qualified business income tax deduction work? Well, here we're looking at a person who had qualified business income of $585,000. They got 0 income, 199A deduction, so they're paying $177,000 in federal income taxes. After the cash balance plan is put in place, their qualified business income was $300,000. They get a $60,000 199A deduction, thus having a total taxable income of $240,000. So therefore, they're paying $60,000 in federal income taxes and saving $117,000 or 66%. We're able to reduce their federal income tax by adding in place a cash balance plan. Next steps. One of the things we can do at OJM Group is help you design a qualified plan that would fit your specific goals. What funding level makes sense for you? What type of qualified plan makes the most sense? Define contribution plan, a defined benefit plan, a combination of both, and specifically look at the economic analysis to show you how would those kinds of plans fit into what you're trying to do for retirement savings, thus lowering your taxable income and putting it away in a creditor-protected vehicle. I appreciate you taking the time to view this. Thank you.
OJM is a multidisciplinary wealth management firm, and we've worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.